we continue to be rather puzzled by something. Japan is an economy that has been in a funk for 30 years, a funk that is widely associated with ageing. And yet in the current macro debate about whether Japan is now emerging from that funk, the focus is all on the workers, with very little discussion at all about what's happening with pensioners. To us, perhaps only to us, this seems like a glaring omission, given pensioners account for 30% of the population, perhaps 40% of spending, and currently have confidence levels that are lower than everybody else. The focus on wages and workers also obscures the fact that the big cyclical weakness in the economy is the failure of consumption to recover after COVID. And it directs attention to the savings of corporates, when actually, as big an imbalance in the economy is the high savings of the elderly. Today, we want to get into the details of all of this and what it means for policy and for the economy. Before we do, I wanted to remind you that this is part of the research we do at East Asia Econ. We publish a variety of reports with something coming out most days on China, Japan, Korea and Taiwan. All our research can be found at eastasiaecon.com, where you can also find hundreds of interactive and updated charts covering all aspects of macro in the region. Please get in touch if you have an interest in subscribing. And with that, back to the story. We first looked at the macro implications of weak pensions in our video last week, so you might want to check out that first. The main observations, as a reminder, were that the weakness of consumption, a weakness that can be traced to the weakness in real pensioner incomes. Now we delve into all of this a bit more deeply this week, starting by looking at the interaction between sectoral incomes and sectoral savings. So, much of the market discussion on macro in Japan, and particularly the imbalances in the economy, focuses on firms, and in particular the corporate sector's shift following the bursting of the bubble back in the 1980s, from being a net borrower to being a net saver. That indeed is a very important change, and its reversal is one of the developments to be looking for to gain confidence that Japan this time really has exited from deflation. However, the move of the corporate sector into surplus is only true on a flow basis. While companies are repaying debt each year, that process hasn't been rapid enough to erase the overall stock of debt owed by the corporate sector, which still stands at around 100% of GDP. From both a flow and a stock perspective, the big saver in Japan actually remains the household sector. In aggregate, individuals are perhaps saving a bit less of their income than they used to. But even on this flow basis, the overall household savings ratio hasn't become negative. As a result, the household sector has continued to accumulate more and more assets, pushing up its total stock of net financial assets to around 300% of GDP. Why does this matter? It matters for incomes. The different picture of savings pertained by flow and stock data has a couple of implications. First, it affects current incomes. Obviously, interest rates have been falling in Japan for years and years. And equally obviously, lower rates hurt creditors and benefit debtors. Given the distribution of saving and borrowing, this shift in interest rates would already be bad for the household sector. But in Japan, the pain is compounded because very little household money is held in risky assets, with most instead being kept in low-yielding bank deposits. Annual household survey data give no indication that the reallocation away from bank deposits towards equities is yet occurring. Effectively then, this backdrop means a shift in resources to the corporate sector at the expense of households. For firms, annual national accounts data show that the deficit in overall net returns from financial assets and real estate has narrowed from 6% of GDP in 1994 to less than 1% in 2021. The flip side has been a fall in the surplus for the household sector from 7% of GDP to under 5%. The quarterly corporate financial accounts collected by the Ministry of Finance show that for interest payments only, the corporate sector has moved from a net deficit to a net surplus. Along with a rise in other non-operating income, that has led to a sharp improvement in overall corporate earnings. The second implication of the composition of the stock of savings is that addressing weak domestic consumption isn't just about encouraging companies to spend. Given its large stock of net assets, the household sector also has an important role to play. But if getting companies to increase outgoings has been difficult, and it clearly has been, given it still hasn't become a net borrower on a flow basis, despite years of government pressure to increase capex and wages, then persuading households to shift course will likely be even trickier. One reason is the weakness of overall household incomes, which isn't a situation that will help households in general to feel confident about opening up their wallets. Macro policy is, if anything, making this situation worse, and not just because interest rates are low. The national accounts divide income generation into two stages: primary income and secondary distribution. Primary income for households mainly covers wages, entrepreneurial earnings, and income from property. Secondary distribution includes taxes, social and other transfers, and is an important stage in addressing inequality both within sectors and between sectors. In Japan, particularly since the global financial crisis in 2008, this second stage isn't doing anything to offset the weakness of property incomes for the household sector. The burden of taxes and social security payments on the household sector rose by 2 percentage points of GDP between 2009 and 2021. In the same period, cash incomes received by the household sector in this stage of secondary distribution remained at around 18% of GDP. Before the one-off transfers given out during the pandemic, the overall household share of GDP had fallen under 60%, reaching the lowest level for at least 30 years. This flatlining of social benefits since the financial crisis represents a change from the steady increase that was seen before 2008. As we discussed last week, an important driver of this shift has been changes to pensions. Reasonably concerned about the financial stability of the pension system, the government in 2004 passed legislation to increase contributions, but also to restrain payouts. Between 2004 and 2017, the national pension contribution was raised by 280 yen every year, and has increased further since then. The mechanism for determining pension benefits isn't so straightforward. It involves a so-called macroeconomic slide, which adjusts downwards a standard price and wage indexing approach to take account of the rise in life expectancy and the fall in the working age population. According to an explanation from the Ministry of Health, Labour and Welfare, the amount of pension usually increases in response to wage and price increases. However, during the period of adjustment, the increase of the amount of pension should be suppressed to be lower than the increase in wages and prices. This mechanism, the Ministry goes on to explain, will continue to be used until the financial situation of the pension system is deemed to be sustainable. This slide has now been applied 3 times, in 2015, 2019 and 2020. According to official data, the monthly old age pension system in the current fiscal year is a bit over 66,000 yen, hardly changed from the level of 2010. Official bottom-up survey data show that annual incomes for the households of the over 70s have fallen from about 5 million in 2002 to 4.3 million today. With the CPI rising by 11% since 2010, these income data look even worse in real terms. Arguably, even that adjustment understates the negative trend in the purchasing power of the elderly. Inflation since 2021 has obviously been particularly high, and the biggest driver of that acceleration has been food prices. That matters when food tends to be a disproportionately large part of the outgoings of pensioners. The extra financial pain being felt by the elderly population can be clearly seen in consumer confidence, which in the years after the financial crisis has been routinely weaker than for other people compared with the rest of the population. So this all has pretty big macro implications. That's partly because the elderly population is so big, with pensioners now accounting for 30% of the Japanese population, compared with 17% in the US and 23% in Germany, so the fall in real pensions pulls down overall average household incomes. and thus acts as a drag on total consumption in the economy. It also because it is the elderly who are sitting on the biggest stock of assets. We discussed that issue a few months ago in some detailed work we did on demographics. The point is that on a flow basis, pensioner households are finally dissaving, although that's only really been true since the financial crisis. Probably though, they could be dissaving more quickly. It's the oldest households that still have the highest levels of wealth. The implication is that the elderly play a key role in not one but two economic imbalances in Japan. The financial squeeze on pensioner households is an important element in the current cyclical weakness of aggregate household incomes and therefore of consumption. And it's consumption being weak that's holding back overall GDP. But it's also the elderly that are pushing up the stock of savings. So what does this mean for policy? One thing it seems to suggest is that policymakers can't really afford the exchange rate to depreciate more and therefore push up food prices even more, which suggests on the one hand the need for continued policy tightening. However, the large number of pensioners on the inflexible incomes suggests that for real economic recovery, worker wages need to rise even more quickly than the market currently thinks, which, if anything, argues for policy to be even looser. This dilemma likely means the BOJ can't yet move decisively in either direction. Probably the other consequence is really for a need for a rethink about fiscal policy. On the one hand, to tackle the real weakness of pensioner incomes, which is a direct response of policy, and also to try to do something to address the very high savings of the elderly. Again, more research like this on Japan, China, Korea and Taiwan can be found at eastasiaecon.com. Please do think about subscribing, and thanks very much for watching.